In our last lecture, we left off pondering the question, what does FOB stand for? Well, FOB stands for free on board. Again, FOB stands for free on board. It is a freight terminology. When products are being shipped, the terms are either going to be FOB shipping point or it's going to be FOB destination. And to simplify it, if the terms are FOB shipping point, it means the buyer is paying the freight cost. If the terms are FOB destination, it means the seller is paying the freight cost. Again, if it's FOB shipping point, the buyer pays the freight cost. FOB destination, the seller pays the freight cost. Now, why is that important? Because if the buyer pays the freight cost, ownership of the good passes to the buyer when the public carrier accepts the good from the seller. Whereas if the seller pays the freight cost, ownership of the goods remains with the seller until they reach the actual buyer. So when you're buying items from, let's say, overseas, if you're paying the freight cost, FOB shipping point, then you have ownership of the goods from an accounting standpoint while they are in transit. If the terms are FOB destination and the seller pays the freight cost, the seller still owns those goods until they reach the actual buyer. Now, if the buyer pays the freight cost, then the cost for shipping is part of the inventory account. Again, when the buyer pays the freight cost, the cost for shipping is included in the inventory account. In contrast, if the seller pays the freight cost, the freight cost is recorded as an operating expense on the income statement for the seller. Okay? So remember that we just bought those supplies previously. Sauk Stereo did, and there's a freight cost in the amount of $150. Assuming that the buyer is paying the freight cost, you would debit inventory and credit cash. Because again, when the buyer pays the freight cost, the cost of the freight is included in the inventory account. Now, if by chance the seller had paid the freight cost, the seller would debit an account called freight out, which is an operating expense, and credit their cash account. So once again, if the buyer pays the freight cost goes into the inventory account. If the seller pays the freight cost, we have an account title called freight out, which is an operating expense. Okay? Next up, purchase returns and allowances. So of course, a purchase return is when you purchase a product, but the product was returned. Perhaps it was damaged, defective, didn't fit right, didn't meet your specifications. For some reason, you decide to return their product. That's known as a purchase return. With a purchase allowance, you choose to keep the product, but the product, once you receive, it was damaged. It had a ding in it, it had a scratch on it, and you ask for a purchase allowance, which is a reduction from the seller of the original purchase price. So you're saying, yes, I'll keep this product, but because it was somewhat damaged, defective, irregular, I'm not paying full price for it. And if they give you a purchase allowance, that is a reduction from the original purchase price. Okay. So assume that Sauk Stereo returned goods costing $300. So because of the return, they would debit accounts payable. Remember that they bought the products on account, they haven't paid for them yet, and then they would credit their inventory account. So when you have an actual purchase return, you would debit the accounts payable account and credit your inventory account. In a perpetual inventory system, a return of defective merchandise by purchasers is recorded by crediting A, B, C, or D. D is correct. As we just saw, when there's a return with the perpetual inventory system, you would debit accounts payable or cash, depending on how you pay for it, and credit your inventory account. Okay? Now, recall I showed you an invoice previously, and it had some terms that said 2/10, N/30. These are known as credit terms. Often when companies buy from other companies, they do not pay cash up front for those products. They receive products on account. They're given a specified amount of time to make the actual payment. Most invoices between two companies will have what's known as credit terms. Now these terms say 2/10, N/30. What does it mean? I'm glad you asked that question. This is saying that if they pay within 10 days, there's a 2% discount offered, known as a purchase discount. Otherwise, they have 30 days to pay for the invoice in full. Again, if paid within 10 days, they receive a 2% discount, known as a purchase discount. Otherwise, the full amount is due within 30 days. So the advantage of offering these type of credit terms, it is going to increase or expedite payment being received from the actual customer. So it's a win-win. The seller is going to get their money quicker, and the buyer is getting a discount. And who doesn't like discounts? Okay. Now there are different type of terms. We just discussed the 2/10. Again, 2% if paid within 10 days, otherwise due within 30. Terms may say 1/10 EOM. This is a 1% discount if paid within the first 10 days of the next month. So the EOM stands for end of the month. Or it could be N/10 EOM, net amount due within the first 10 days of the next month. So again, different invoices will have different credit terms. Make sure that you understand what those different credit terms represent. So again, in our problem, remember that initially the amount owed was $3,800, but then we had a return for $300. So the amount owed was $3,500. The invoice date was May 4th. It is now May 14th. So we did pay within the 10-day discount period. Remember the terms were 2/10, N/20. So to record the actual payment, your debit accounts payable for $3,500. You will recognize a 2% discount. So what is 2% of $3,500? If you say it's $70, that's correct. But notice that the discount goes into the inventory account as a credit. That's because we're not paying the full price for the inventory because of the purchase discount. So the discount is shown as a credit to the inventory account. We'll then credit cash the remaining balance of $3,430. So again, the terms were 2/10, N/30. We did pay within the 10-day discount period, receive a discount of 2% on the remaining balance in the amount of $70. The amount of the discount is shown as a credit or a reduction to the cost of the inventory account. Okay? Now, if we did not pay within the discount period, then the full amount is just owed. It would debit accounts payable and credit your cash account. Debit the accounts payable and credit your cash account. So the question may be asked, should a discount be taken when offered? Well, we can take a look to see at the benefit of doing that. We understand that, again, if we pay within the 10 days, we receive a discount in the amount of $70. Now, what if you took $3,500, invested it at 10% for 20 days? Now, let me just caution you. I don't know where you're going to invest that amount of money, get a 10% return, but this is academic. Let's say you did. But even with that being said, notice that you were still only earning interest $19.18. So, of course, it makes sense to take the discount, because even if you got a 10% return in 20 days, the discount is still going to give you a savings of over $50. So most companies will take advantage of the discount because of the cost savings. Let's take a look at the inventory ledger account once we recorded all of these transactions. So remember, initially, the purchase price was $3,800. We then had a return for $300. We purchased for $3,800. Then we paid the freight cost of $150. Those both increased the inventory account. We then had the return for $300 and the discount in the amount of $70. So currently the inventory account has a balance of $3,580. Okay. Now those were transactions by the buyer. Let's now look at transactions on behalf of the seller. When the seller sells product with a perpetual inventory system, it requires two sets of journal entries. One to record the actual sale, and one to recognize and record what's known as your cost of goods sold. So when the sale takes place, it's either going to be made on account or in cash. You'll debit those accounts and credit sales revenue. The second entry says, what was the amount that the company paid for those items that were sold to their customers? That amount goes to the account called cost of goods sold, which is an expense account. You're then going to credit your inventory account for, again, the cost that the company paid for those same items. So going back to our example, we're now going to be the seller, all right? We're now going to be the seller. We know we sold the item for $3,800 to Salk Stereo. But we're saying that PW paid for those same items $2,400. So to record these transactions on behalf of the seller, we would debit account receivable and credit sales revenue for the $3,800, which is the actual sale price. You would then debit cost of goods sold and credit inventory for $2,400, which is the amount that PW paid for those supplies. I'm sure you all didn't think that the amount that you pay in the store is what they paid for it. Surely not. So your cost of goods sold will always be less than the actual sales price, because that's how they make a profit, by marking up the cost, selling for a price higher than what they actually paid for it. This is some good stuff, ain't it? Okay, so we're going to stop here, and we're going to come back with our next video, continuing our lecture on Chapter 5, Merchandise Inventory.